SLV is a designer, manufacturer and marketer of lighting fixtures. We source the lighting fixtures in Asia. We outsourced production many years ago. The big asset here in our group is that we are able to recognize trends, that we set the design. We have each and every fixture on stock. And if the customers place the orders with us, we distribute them at the same day, which is unique in the lighting industry.
It had an industry model that we recognized. It had a pattern that we recognized in terms of the fragmentation of that market, but the clear reason for success. It had strong financial metrics, it had a strong culture, strong drive, and a management team that we knew we could back.
We always think that we're quite thorough on due diligence and really do our homework. I have to say Mittelstand is even more so. They really dig into us as HG Capital. They really want to know who they're dealing with, who they're selling to. They do due diligence on us in the way that they look for areas how they can find out more about the people who they're dealing with. So reputation is key. You need a really good reputation. So that's the starting point. And then you need a lot of understanding. We outbeat a couple of our close competitors, but not by just paying the highest price, but by offering the best structure, which ended in a situation where we paid 10–15% less than the highest bidder, because we had the vote of management, but also the vote of the owner, who was looking for the best owner for his life, actually, because he had built this business over 30 years before selling it to HG Capital.
The HG Capital guys managed to buy a family business with a dominating founder, managing director and majority shareholder. The different parties, like the private equity investor, the former management, the former shareholder, the new management, the banks, they were able to make one thing out of these different people and to align interests. And managing all these things was a big achievement from HG.
In terms of key drivers for growth, what we decided with this business was it was very capable of internationalization. And what we did in terms of how we did that, we looked very clearly at European countries that were near and some that were slightly further out, but we also wanted to broaden the reach.
When we finished our work 3.5 years later, 60 Germany, 40 foreign countries split had developed into close to 70 foreign country, 30% Germany split.
They managed to bring the business to the next stage. So we more or less doubled the size of the business since HG Capital bought the business. And so they created an environment which enabled the company and the management team to steadily grow the business.
The business generated roughly 70 million sales when we invested in 2007, mid of 2007, developed well through 2007 and 2008, had a flat year in 2009 because very difficult markets, competitors went back double digit, we stayed flat, whilst even accelerating our market share gain. And then in 2010 into 2011, again accelerated growth. We started with 25–26 million EBITDA at the time and ended with 50, 51, 52 EBITDA. So nearly doubled sales and doubled profitability through the crisis.
HG Capital really created an environment of trust and partnership. The management had the opportunity to grow the business and there were more or less no restrictions.
We made 4 times cash on cash over a period of 3.5 years. We thought about the exit in 2009. Why? Because we looked at the landscape and said, if a business performs so well in the crisis, as soon as the storm is over, this business will go back to double-digit growth. You can either sell later and there isn't any fat on the bone left, or you can sell and leave something to the next owner, which we did in this case. We made 4 times cash on cash over a period of 3.5 years. I met the partner who bought it from us, and he seems to be very happy because the business outperformed business plan, which is also good for us and good for the company.